All right, so then now we'll go through again the PowerPoint for Chapter 1, which is just kind of an introduction into auditing. So our learning objectives, I won't read through those. Those we should have out there in Brightspace. So we'll kind of skip through those. Okay, so describing auditing. So basically, auditing is the accumulation of evidence. So the auditors are there at a corporate company and they ask for, various different documents, and they're going to put those all into their work papers, and then the auditing managers and partners review it to prepare a report. So then the report is going to say they are either in compliance with generally accepted accounting principles and they're reasonably sure that they're free from material misstatement. That's the ultimate goal of the audit. And it should be performed by an independent person, normally a CPA. So normally the companies like to have CPAs because, again, it knows you know your material, and again, you're independent of that company. So information and established criteria. So again, we're pulling this evidence based on the information we want, and our established criteria for most audits is generally accepted accounting principles. The competent independent person is the CPA, and then we're eventually trying to prepare a report. Now this gives you an example of what if you're an IRS agent. So now you're auditing a tax return. So you are that competent independent person as the IRS agent. You are going to examine whatever documents you asked for in the audit. So they may ask for like their bank statements, canceled checks, receipts, kind of whatever they're auditing you for. It's going to be the information is going to be the federal tax return. It's going to be subject to the Internal Revenue Code. And then you're going to get to the end and say, okay, you either owe us additional taxes or your tax return was fine or whatever. So again, that's just an example to just show you that it could be anything. So mostly what we'll talk about though is publicly traded companies following GAAP, but it could be any type of auditor. And accounting, so the difference between accounting and auditing is the accounting is the people who work in the company and they're actually recording the information, they're classifying the transactions, then they take all those transactions and again, it gets posted into their general ledger, they create a trial balance, financial statements, and they prepare those financial statements for then the auditors to look through and make sure that they are properly reflecting the economic events of that company. So the accounting are the people who generate the numbers to create those statements, and the auditors are looking over the big picture to say, yes, they look fairly stated and they are following GAAP. So then the PowerPoints like to put like little discussions at these various topics. So we'll just kind of, we won't really discuss them. I'll just kind of go through them kind of quickly and discuss what I think is relevant out of these. But so it asks what information and established criteria would be necessary for the Jones Company's tax return by the Internal Revenue agent. So obviously they're going to look at that tax return itself. That's going to be the starting document. And then they're going to go back. So they may say, okay, you have acquired a new asset and you're recording depreciation. We'd like to see the purchase agreement of that asset, or we're questioning that there wasn't sales that were possibly not recorded. So can I look at your checking account statements to see what deposits came in, and then I can trace those into that tax return. If it was the audit of the financial statements by a CPA firm, they're going to start with like the income statement and the balance sheet, and then they're going to work their way back. So they may say, okay, I'm looking at the balance sheet. I see that you have so much in your cash accounts. Show me the bank statements that support that. I see you have so much in accounts receivable. Show me an aging trial balance that supports that number. So much in accounts payable. Show me what you owe out to your vendors. Then from an income statement standpoint, That's where it's a little harder. They may just randomly pick transactions to say, okay, I'm going to go through revenue and I'm going to pick all the revenue transactions that are over a certain dollar amount. And then I'm going to trace those through to all their source documents, verify that they're legit. They may go to the end of the year and say, okay, show me all your transactions on December 31st, because I want to make sure you put them in the right period. So those are all kind of things the audit's going to look at. But again, they start with those financial statements and work their way backwards. So if the auditor did not thoroughly understand accounting, then they couldn't really do their job, right? They wouldn't know what to ask if they didn't know, like, how does an accounts receivable balance even get there? They're not going to know that they got to look at the aging of the customers, and they've got to maybe do some third-party verification of those balances. Where accountants, they don't necessarily have to know the audit. Like, so if you graduate from college and you go to work at Diebold, you might never ever do an audit in your life. You might not even be involved in the audit of Diebold. So you don't have to know auditing, but the auditor has to know accounting, because that's actually what they're double checking is being done correctly. Okay, then the demand for the audit is really all publicly traded companies are required to have an audit. So the Securities and Exchange Commissions requires that for companies to be publicly traded. But then, so I mean, that's really ultimately the major demand for it. But it's also, though, ties back to what this slide talks about, information risk. In today's world, we have so much data, and there's so much data that is just coming in, possibly even like, electronically, where we're scanning documents, it's going in. Well, then we're gonna summarize that data to create these financial statements. If the data is inaccurate or not reliable, our financial statements are not going to be reliable. So then again, people who want to invest in a company or banks who want to loan money to that company, they want to know that those financial statements that are being presented to them are reliable. So that's what the auditors give us, is like that. They make it reliable. So we've got information risk. So again, that is the risk that information that we're compiling is going to be inaccurate. So there's some things that increase the likelihood that information could be unreliable or inaccurate. So like the remoteness of it, again, like companies that are consolidating and bringing in operations from possibly even all over the world. It's a little bit harder maybe to double check that data as it is getting downloaded into your system. There could be people who are intentionally manipulating some of the data that comes in. It could just be that there's so much data, it's really hard for like even internal auditors to review it all. And then as we again deal with foreign companies that are possibly consolidating in, there can be very complex transactions that are happening over in the euro or the yen, and then now we're going to translate them into US dollars and bring them in. So there can be all kinds of very complex things that make it hard for just an average accountant to kind of understand and get comfortable with. So 3 ways to reduce this information risk is that the user verifies all that data. But so like I just said, when it's coming in from maybe all over the world, all over the country, just tons and tons of data, it's super hard for users to verify that. They share the information risk with the management, again, like what's going on and how it's hard to comprehend all of that. And then audited financial statements. So audited financial statements are the most reasonable way to reduce information risk. And then this shows a relationship again between the auditors, the clients, and external users. So the reason we do audits of financial statements is because the external users want to rely on that data. They want to be able to look at a financial statement and verify that it is, or feel comfortable that it is actually following generally accepted accounting principles and that it's actually correct, that people just didn't push numbers through. So the client is providing those financial statements to these external users. These external users are primarily shareholders or banks. And then what does the client get from a shareholder or a bank? They get money. So the shareholders are going to invest money in their stocks or in bonds, and then the banks are going to give them loans. So the clients need money from stockholders or banks, and then the external users, the stockholders or the banks, want to know that the information that they're looking at is actually legit. So that's where the auditor comes in and says, okay, well, we're going to do our best to make sure that this information is actually correct. So then the discussion question here is, what is meant by determining the degree of correspondence between information and established criteria, and what are the criteria of an audit of a company's financial statements? So really, it's that the company is following generally accepted accounting principles. So that's what the Securities and Exchange Commission requires for all publicly traded companies to use GAAP and to prepare their financial statements in a way that's consistent with GAAP. So the auditors are really looking at that. And the auditors do not make a guarantee. They say they believe it to be free from material misstatement. So material is a key word in there too, because they're not saying that every error is caught and that every little mistake is corrected. It's got to be something material, and material would make a difference to the bank or the stockholder. So it's got to be a pretty big number. Okay, so again, more discussions. There are 3 factors impacting loan interest rate. There's the risk-free interest rate, business risk, and information risk. So which one or ones does the auditor reduce? They're going to reduce the business risk and the information risk. The risk-free interest rate is what is set basically by our government. Every quarter, they determine what our interest rates are going to be. Then the bank is going to fluctuate that based on the business risk or the information risk. So business risk is this business going to be in business next year? Is it like on the way out? Is it a going concern? So that's what they're looking at. And then the information risk is the information that we've compiled and put in these financial statements accurate and really reflect the operations of the company. So the auditors look at both of those. And then the 3 main ways that information risk can be reduced. So that goes back to that slide a few back. So what we said was that really using the auditors is going to be the best way. So that's why publicly traded companies are required to, and that's why they're willing to pay. I mean, audits are expensive, so that's a disadvantage of the audit, is it's costly. But the advantage is that you have those outside CPAs that know their stuff, come in, look over all the information, and then sign off on a letter that says these statements are fairly presented. So that's what most companies, again, do. Okay, then we're going to look at assurance services. So assurance services is an independent professional services that improves the quality of information for decision makers. So that's going to be done by CPAs or by firms that are primarily employed by CPAs. So you figure in a CPA firm, not everybody has to be a CPA, but the majority of the people should be. And then they are following the Sarbanes-Oxley Act, where the CPA firms that are hired to audit the publicly traded companies are also going to look over their internal controls. So again, we'll have a couple chapters on that later on. But the internal controls can help the auditors either feel comfortable with the material that they're looking at or make them realize they got to do more testing to get comfortable. Okay, so an attestation, I always feel like I say that word weird. I'm still going to struggle. Attestation service is a type of a assurance service, and it's going to be an audit. So an audit of those historical financial statements, an audit over that internal control structure that governs the financial reporting. It could also be a review. So publicly traded companies have to be audited Privately held companies can just have a review of the historical financial statements. So again, the public means because it's outside stockholders that can invest. In a private company, it's owned by private people, could be owned by owners of the company or even employees of the company, but they may not require the full-blown audit. It's just a review. Then there can be other ones. So again, and they'll give us a table of some of these different other type of assurance services that could be offered where the CPA is not required to issue that report to say these reports are fairly stated in conformance with GAAP. Things that CPA firms can do for companies that are non-assurance related, they could do accounting and bookkeeping services. So that would be for those smaller businesses that they're not actually doing an audit for. They can perform tax services, and those could be for an audit client, and they can also do consulting services. They just can't do accounting and bookkeeping services for a company that they're also auditing, because in a sense, they'd be auditing their own work. So these tables go through some other examples that you might not necessarily think about. So controls over investments and policies relating to financial derivatives, mystery shoppers, like, you don't necessarily think of that. The accumulation and storage of digital information, fraud and illegal acts, ingredients, compliance with entertainment royalty agreements, ISO 9000 certification, corporate responsibility and sustainability. So again, those are not things that you're going to have to know for your tests or anything, but those are things that audit firms could do. So then the types of audits that CPAs most commonly perform are operational audits, compliance audits, and financial statement audits. So our focus in this textbook is financial statement audits. But again, the CPAs could perform those other ones as well. So in an operational audit, they give us some examples. So evaluate whether a computerized payroll processing for a Chinese subsidiary is operating efficiently and effectively. So then you're going to look through the payroll records. You're going to look through their policies and their standards. And then you're going to look through these various reports to see, do you see any errors? Do you see any discrepancies? And then you'd come back and give a report to say, yes, it's in compliance, it's following the procedures and it's operating efficiently, or it's not. The compliance is like, so with bank, when you are a corporation and you have large bank loans, they have like covenant agreements that go along with that debt. And you do have to have your auditors verify that you are complying with those. If you're not complying with those requirements, that entire loan could come due and payable immediately. So the auditors normally do a compliance audit to verify that all those bank requirements are being met. Because again, it is kind of a big deal to the company. And then we'll focus all on the financial statement audit in this book though, and we'll talk about the generally accepted accounting principles and the documents and the evidence that the auditors are going to pull. So in practice from auditing, we have all of our CPA firms. So like I said, there's the big four, then there's national, then there's regional, and then there's local. So there's all different levels of public accounting firms, and all of those levels can do audits. So it depends on what type of company you are. If you're obviously a big, you're Amazon, you're going to be using one of those top four companies. If you are just a local business around, say like in Stark County, you might use 415 Group, which is just a local accounting firm. So again, it depends on your size and kind of what you need. Because again, all those levels, the higher you go, the more money you're going to pay. There's also government accountability auditors who work for the government. We had one of our alumni works over works for the state of Ohio and works just right over at the Kent building, and she works in that government accountability office. There's internal revenue agents who would work for the IRS, and then there can be internal auditors. So some big corporations staff their own internal auditors, banks will staff their own internal auditors, and they go through and make sure that all the internal control procedures are being followed, trace transactions through, just investigate things before it gets to the external auditors. So you would still have both, but the internal auditors may save money in the long run if they can catch things ahead of time. So what are the similarities and differences among the three types of audit? So again, it depends on what they're looking for. So I feel like internal auditors are looking through the internal control structure and making sure policies and procedures are being followed, making sure that documents are being retained when they should be, and that the traceability is all there. Now then the external auditors will still come in and double check all that stuff, but they'll then even take it one step further to go into the financial statements, verify balances, do some random sampling, that type of stuff. The government and the IRS are different. They're obviously looking at different things. So they're going to be looking at, did you file your taxes correctly? Were all the transactions properly accounted for? Did you pay your taxes? So different, pretty different focus between the government and the IRS compared to the internal and the external auditors. Okay. And then I think I'm going to skip over that because, again, there could be operational audits. You could have any different type. Like they gave us the example of, is a subsidiary following your payroll procedure? But you could have like, is inventory management being done at an offsite facility? And there can be so many different. It's just like what the company's doing inside the company. Are they following their procedures properly? So they could go in and look at those types of things from like a inventory management standpoint, a payroll standpoint, what else kind of a thing? Could even be like a production efficiency standpoint, quality, like a quality management standpoint, because we're talking about it inside a manufacturing company. So there could be a variety of things that then the auditors are going to come in and just make sure things are being followed. Does the knowledge, or what knowledge does the auditor need about the client's business in an audit of historical financial statements? And then explain how this knowledge may be useful in performing other assurance and consulting services. So the auditor does need to understand about the industry as a whole, as well as that client's business itself. So normally if it's an ongoing client, and if you are an auditor, you're told, look at prior year work papers. I was an auditor right out of college. I didn't like it, by the way, so I'll preface that. But that's what all I heard. If I asked any questions, it's like, look at the prior year work papers. So in the prior year work papers, they probably answered all of that stuff. So you got to take the time to kind of get into that and make sure you understand those prior year work papers before you can move on to this year's audit. Because a lot of times it's the exact same stuff that you're doing unless there was a major business change. You also have to know the client's industry, because say like when I worked in oil and gas is very, very different than say like a manufacturing company. So you've got to understand the industry and how does that impact accounting and how does that impact those financial statements if you really kind of want to understand it. But then you can become like a pro, like you could be like the best oil and gas auditor out there because you audit maybe a variety of oil and gas companies, you know what's going on, you know the best practices. So then you could be super useful in like consulting with those companies, or maybe then they even pursue you to be like the CFO or something like that. So it definitely helps to have that knowledge base. So if you want to be a CPA, which again, hopefully a lot of you guys do, you do have to know your licensing requirements in the state. So the state of Ohio, January 1st, switched back to just requiring your bachelor's degree. Used to require 150 credit hours, which would be a master's degree. Could be a bachelor's degree if you had like a minor and took extra classes. But now they've switched it back to just bachelor's degree only, But unfortunately, when they did that, they did away with anyone having an associate's degree being able to get the CPA. So you got to have your bachelor's degree, then you take the CPA examination, and then depending on what field you're working in, if you're in public accounting, it's just 1 year of experience. If you're in private, it's 2 years of experience. So you have to have all three of those: your degree, pass the all parts of the CPA exam, and then have either a year or two of experience. So again, it does depend on the state. So I was telling you what's happened in the state of Ohio. So we'll kind of skip through that page. So again, the CPA exam though has changed. So like when I took it years and years ago, there was just 4 parts, and everybody took the same 4 parts. We also took it pencil and paper in Cleveland. Took 2.5 days. It was extremely painful. Now it's all done online, and you can kind of like pick which discipline you're in. So there's 3 parts that everybody takes. The 4th part you can pick. My son just took the CPA exam last year at this time. He did pass all 4 parts. You just take 1 part at a time. But his discipline that he picked was tax. So he took tax 1, which is required, and then he picked tax 2. The reason he picked it is because it was said to have the easiest or had the most pass rate. So it's not like he necessarily loved tax, but he just knew it was going to be the easier of the ones to choose from. So again, and those, I feel like that changes all the time though, so it might not always be the easiest, but this particular go around it was. So here is the core that everybody has to take. So tax compliance, which is what I was saying was like tax 1, business analysis and reporting, which is kind of like your basic financial accounting, intermediate accounting type information. And then information systems and controls. So I think that's more the auditing side, really, right? Because then do they give us no, they don't give us that. But because maybe that's even different per state what your choices are. But I feel like there's a tax one, there's more of an IT one, and then there's a higher level of business analysis and reporting that maybe gets more into like not-for-profit and some of the more unique types of accounting. I was hoping they'd have that in the slide, but they do not. Okay. And then that is it, because we've talked about those. Good. So that is it then for our chapter 1. So it really is just more of a introduction into auditing, kind of understanding the difference between auditing and accounting, and just kind of getting your mind around just the different agencies that govern it and why do we need it.